All right, Jeff, can you walk us through this chart?
Yeah, so this is, in fact, this is a really good example of why we do what we do. So most statistical processes will look at a t-stat, and that gives you some type of relevance as to how good the data is in terms of its predictability or the relationship between two data points. Well, sometimes, and this is a really good example, sometimes data is not linearly represented. And so a t-stat, which is really measuring that linearity, won't work. And that's the case here. You can see a t-stat, which is, essentially above 2 or below -2 ends up being significant. So this one would fall right in sort of the middle of that range. But as you look at the data, what we do is we say, okay, given this data, what does that imply for forward returns? And so we break this data up. And in this case, we're in the 100th percentile, which means this is the top 10%, this line. And we'll break all this data up into 10 deciles. And that's represented here in these data points. So as an example, in this top decile, you can see that the S&P forward returns after we get the percentage of issues making 20-day highs that's above 27% actually tends to be significant and meaningful. This is the average return over that same 3-month period for the Russell. And then when I'm in that top decile, you can see that I'm substantially better than that. As we get into these sort of middle deciles, the 80th through the 20th, there's really no change between the average return and what you would expect. And, if anything, you could say in the 60th decile, things are a little weaker, but it's not statistically meaningful. But as we get over here, you can see that, the tails in both of these actually tend to be relatively bullish. So this middle chart, this middle pane is just showing the data that we're talking about. Then we break that down into the various deciles. So you'll see a thin band or a thick band like you do today. And then those deciles are represented, and the returns of those deciles are then represented down here. What we also do is we take the stats when we're in this top zone here, and we just tell you historically what has happened in terms of the return functions. In this case, for the Russell 2000, 73% of the time when you're in this top decile, you've got a winning trade. The average of that winning trade is 10%. The average of that losing trade, which would be 27% of the time you lose, would be down 6.8. So a lot of information. I can see how it's confusing, but really try to break that out so you can see visually pretty quickly whether or not we're in a good spot or a bad spot or an indifferent spot for the various equity markets and sectors.
Thank you.